The Japanese market take a rise off the back of that. There were some deals with the Philippines as well. There's been obviously the China one that was a massive one for the previous month, but there's been some certainty around trade and some of the bigger trading partners to the US, which has given market certainty, which is why markets are ultimately performing well off the back end of it.
Markets like certainty, and there was bad news coming because everybody was going to get a tariff, so it was just...
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again, back in the recording studio.
Andrew, we love this time of the week, especially when we're going to give everybody a market wrap.
Yeah, absolutely. It's always an interesting one to do the rounds and see what's been happening in the last month or so in investment markets. So, Bills, kick us off.
Well, you know what I must say, just before we start, it is the most exciting time, I would say, and we probably need to thank, and for a period of time, probably because of Donald Trump and all of the stuff that comes out of his mouth and moves markets and stuff like that. So it's actually been... It's been interesting. I wouldn't say good, but it's definitely been interesting, and that it gives us a lot of stuff to talk about, right? So
exactly right. Not that we need too many things to talk about. We could probably just keep talking non-stop and underwater, but that's all right. Always an extra.
This is true, and maybe, you know what, we might even chuck in the Victorian government there and give them a bit of a nudge as well too, Andrew, because there's some stuff that they've been talking about as well that is just blowing my tiny little mind. But let's get straight into it. Always starting in America. So looking at the S&P 500. So this is for the month of July. So it's down slightly, 0.66% for the month. But in saying that, it did hit all-time highs in July.
Yeah. So month in, month out result, or you look at month to month, it's probably not looking that great, but you look at things as to, how they've been tracking in the last little bit. And it's been, hitting all-time highs in the US, I guess. A couple of things. One, US reporting season, and we'll talk a little bit about that. But that, that data has been quite strong, and also some, confirmation, or at least a little bit of peace of mind around some trade deals as well. It's really bolstered the US market.
I've got this smile on my face because thinking about the trade deals, why didn't Donald Trump just come out and say 15% is our default position?
Yeah.
And that's it.
Because that doesn't make news headlines.
And it could have been done in like a week.
Well, government and efficiency are usually two things that don't go in the same sentence.
And you basically say it's going to be 15%, but if you want to negotiate it lower, you have to come to the table with a lot. And basically everybody would have just, dealt with it and moved on.
Exactly. But that doesn't make news headlines.
No, very true, very true. Andrew, I love this one. We've got some stats sort of tied up into this one as well too. So at the time of this recording, about 30% of companies on the S&P 500 have reported, and this is incredible. So the ratio of companies that have beaten market expectations in terms of their performance is at 88%. Now, this is the highest or the strongest that it's been since Q2 in 2021. So absolutely phenomenal result. And in saying that, the S&P is up 32% since April, since the April low. Just phenomenal. Absolutely phenomenal result. I can't believe that 88% have beaten market expectations.
Yeah. And I think it's one of those things that, and just to maybe share some context around this, the market is always preempting. So the market is always preempting what's likely to happen and factoring that in. So you look at it and say, okay, well, 30% of the companies are, 88% of them are beating expectations in terms of where their earnings was likely to be. And we haven't really seen the market uptick as a result of it, or we haven't seen such a huge uptick in the month end. And the reason for that is the market really expected this to be happening. So it's preempted the fact that it's more than likely that, earnings was going to be strong. And so even if we saw, companies meeting market expectations, we probably would have seen a downshift in market because it already priced in an uptick. So it's really one of those things that in order to see those sustained highs, we really did need to see, company earnings hit such a high level, which it obviously has been.
My question is, have the companies performed better, or is it that the analysts didn't price it incorrectly? Because if you consider what you were talking about with market analysts, I mean, there's people whose job it is just to look at a specific company and basically try and determine whether or not the share price today is reflective and accurate of what's going on, or if it hasn't priced in any information. So if 88% of the companies that have reported so far, that's a huge miss from an analyst perspective. Were they not looking at it closely enough? Did they miss something? Were they being too conservative? Were they factoring in, I don't know, maybe some more turbulence associated with these tariff deals? I'm not sure. Regardless of what it is, absolutely phenomenal result. And it's great to see companies just in general beating market expectations. Generally speaking, markets don't like surprises. If it's on the up, if it's on the down, they don't like it because they like to think that markets are efficient and all of the information that's available is represented in the share price. But 88%, this is an absolute ripper. And hopefully when we see the rest of the companies start to report who are on the S&P, hopefully the result is similar as well too, and we can see markets continue to rally.
Yeah, absolutely. And then you also look at the other, side of, what's been pushing markets up or why we're seeing markets at a high. And we've already touched on it, but getting a bit more certainty around what those tariffs are going to look like and those trade deals has been another really big factor. I think one of the big ones was the US and the EU. So they reached a deal of a 15% tax rate. This was a really big one. And it's a big one because about 20% of US imports are sourced from the Eurozone. So reaching a deal on tariffs is pretty large in that sector. And making sure that, investors have a bit more certainty, so to speak. You also saw some other deals take place. I mean, one of the other more notable ones was the US and Japan. Again, 15% tariff. So going back to Billy's, maybe we should have just done 15% and that would have just been it. But we saw the Japanese market take a rise off the back of that. There were some deals with the Philippines as well. There's been obviously the China one that was a massive one for the previous month, but there's been some certainty around trade and some of the bigger trading partners to the US, which has given market certainty, which is why markets are ultimately performing well off the back end of it.
Markets like certainty, and there was bad news coming because everybody was going to get a tariff. So it was just, okay, just tell us what it is so we can adjust and we move on accordingly. Japanese share price Japanese market up 4.3%. So once again, going back, we could have saved a whole heap of time and not wasted all of this time. Just tell everybody it's 15% and away you go. So
yeah, well, again,
maybe I should be in politics, right? Okay, US housing data was a little bit softer. New home sales down 7% year on year. In saying that, just to confuse everybody, they were up 1% month on month, but it was 4% below expectation and where the consensus was. We've seen the highest supply level in 5 years. So what that is indicating is that there's an increased appetite for people trying to sell. But in saying that, it's going to be challenging because of affordability and oversupply. And is there going to be enough buyers to take up all of these people who are wanting to sell? And what that does do is it's going to push prices down.
Yeah.
So we need to keep an eye on the American property market.
Yeah, I mean, and when you are talking about the American property market, and especially when you are talking about sales and purchases, it is very heavily dependent on interest rates. I mean, again, you look at interest rates and the impact that it has on property market property sales. Mm-hmm. It's significantly large in the US because they do have a long fixed term mortgage as opposed to the Australian interest rate environment or mortgage environment where interest rates are floating and variable most of the time. And so the direction of interest rates will have a fairly significant impact on what happened with the property market. I think that really the interesting thing in the US is going to be how willing the Fed is to look through the effects of tariffs and the impact that that's having to inflation. We are seeing some assistance in the slowdown of underlying inflation. So if we do see, a lower pass through of tariffs, you could see that the Fed may potentially look at looking past the impact that inflation is having on the US market. So going to be an interesting one there, and sort of, toss a coin as to which direction the Fed decides to go on, really.
Well, it's interesting. I mean, you've got the president putting additional pressure on the Fed to reduce interest rates. Now, they are independent. Meant to be. I thought what you were going to say before is it's interesting to see if Jerome Powell is going to resign, because that's what Donald Trump has been. That's what he's been saying and what he's been pushing for. But look, they're steady at the moment, so we'll see where that goes. Andrew, probably a good pivot into China.
Yeah,
the world's second biggest economy. GDP growth came in at 5.2% for the second quarter of 2025. Now that's a slowdown. We are talking numbers of 5, but a slowdown from 5.4% in quarter one. So not much of a slowdown, but enough. And I guess what markets are looking for when they report this data is which direction is it going in, to try and predict what's going to happen. Nominal GDP, which does account for price changes, only grew by 3.9%. Interesting to note, it's the lowest rate outside of the pandemic since quarterly data began in 1993. Yeah.
To sort of compound some of the negative news that was coming out of China, we did see, or there's still a continual decline in home prices in China as well. It was the fastest pace in 8 months. In June was the decline in property prices in China. New prices down 0.27%, and existing properties down 0.61%. So there's really there's hope for property stimulus that's really been raised, and there's a property sector summit that is occurring, which they're hoping that that's going to create a little bit of additional stimulus in the Chinese property market, because it's really needed it.
Is it just me, or are the Chinese always stimulating their property market?
I don't think it's just the property market, Bill. I think it's one of those things that, right? Yeah, I think it's one of those things that it's an economy that is heavily funded on stimulus and heavily funded by the government. And so as a result, anytime that there's a blip or anytime that there's a slowdown, I can't believe we're talking about, 5.2 as a slowdown, or even, annual growth at, 3.9. Yeah, that's considered a slowdown in China. But anytime that there's a slowdown, there's a look to the government to create some stimulus to bring that back up. It's not as much the market and the private sector to drive growth.
Yeah. Closer to home, ASX 200 up 0.41% for the month. Not too bad. Interestingly enough, we were talking about interest rates before, and this is kind of the national sport outside of sport and property is what the Reserve Bank are going to do. But in the July meeting, the Reserve Bank defied consensus essentially, and they kept rates on hold. It was, from what I read, it was pretty much a shoo-in. Didn't happen. So let's call it 12th of August. We're going to see an interest rate cut. That's what I'm seeing.
Well, the market's pricing in almost a certainty that that's it, right? Rates are going to come down in August. And they're even pricing in a 50% likelihood that there's not a 25 basis point drop, but that there's actually a 50 point basis drop. I think that's very unlikely. I mean, you look at, the previous month's data and you look at the fact that the RBA is trying to be very cautious around declining interest rates. And I think that does have some impact, on what's happening with property prices. I do think that the RBA is looking at, what's happening with property prices and the unaffordability crisis, and also trying to manage that to some degree. So I think that a 50-point basis drop is pretty unlikely, but that's the market's pricing in a 50% chance.
Yeah, no, I don't see it. Just thinking about how difficult it is to raise interest rates, and how challenging it is, and the whole range of different stuff, because it does hurt people and households. You're not going to be giving your position away for free. Like, they're not going to do that unless they absolutely have to, and you're not hearing and seeing alarm bells ringing that would justify that. So the fact that it's even 50%, I'm really surprised in saying that. But yeah, expectation is 25 from my end. Like I said, I think it's a foregone conclusion, and looking forward to the repayments dropping on the mortgage.
Yeah, and it's interesting. I mean, you consider some of the economists and what people are talking about at this minute, and how the rhetoric changes just with one decision.
Yeah.
Like last month, there was going to be, an interest rate drop in July. There was going to be, another 3 probably later in the year. And all of a sudden the ABA makes one decision to hold interest rates. And economists are now talking about, we'll see one drop, maybe one more by the end of the year. And all of a sudden things have completely changed. But look, there's still a, very, very, very high likelihood that there's going to be some easing on the pressure from a mortgage side of things.
Yeah, and the other thing that supports that too is we're seeing softer employment data in Australia as well too. Interestingly enough, our employment data, the way that it's recorded, and it's been like this for quite some time, but if you're employed by somebody or if you're doing something for 1 hour a week, you're considered employed.
Yeah.
So what it doesn't capture, and I've never really liked this, and this is really difficult to get your hands on, is underemployment. It's only an estimate. They're basically saying, okay, you might be employed for 10 hours a week, so we classify you as employed, so it looks good when we're looking at the data, but you want to work 40 hours a week or 30, so you're underemployed by 30 or 20 hours a week. What does that look like? And then you think about the impact that has on a budget and things like that. So softer employment data does support interest rate cuts to try and stimulate the economy, encourage businesses to borrow more money, spend capital, employ people, and away you go, rinse and repeat, grow the economy, grow your business.
Yeah, exactly right. And I guess supporting and sitting alongside all of this data that's coming out with regards to interest rates is the property market. We really are seeing the property market heat up. We've been in and around, and we're going to talk about Victoria just because that's obviously our home state, but property market or clearance rates have been strong across the country. In Victoria, I think it's been almost 2 months straight of clearance rates sitting at 70%, thereabouts, which is very strong. And we're seeing it in the mortgage broking business as well. Yeah. People sitting with pre-approvals for a lot longer, finding it harder, getting outbidded. And so we are seeing some growth in the property market. Particularly the Victorian property market as well, which obviously has a bit more ground to catch up on.
Yeah, it's going to be interesting to see where this goes. You're absolutely right. So Melbourne in particular, I think is undervalued and has been for quite some time. Whether or not the stupid rhetoric from the Victorian government's enough to dissuade people from purchasing, but you've got that. Then you've got spring, which is naturally a busier time because properties present well, sun shining, people are coming out of the winter gloom. And then you've got the Reserve Bank who are going to reduce interest rates, depending on what you believe, 25, 50 points, who knows. So you've got all of those things working for you as well too. I think it's going to be a really strong spring selling campaign. I think it really will be. And for those that are in Melbourne, I think irrelevant of what the government are doing, I think it presents some really good value. And we're, like what you said, Andrew, we're seeing it with our mortgage broking business in terms of the people that we're talking to. They're now under a bit more competition. That's only going to get worse as things progress. And the other thing too is there's going to be more stock on the market as well. So it's going to be interesting to see what happens over the next little bit. And hopefully clearance rates can continue to stay as strong as they are.
Yeah, exactly right. And maybe even to kind of tie it all together, when you're looking at property prices further up north, you are considering what's happening in regards to commodity prices and obviously the mining boom. But we're still seeing a really strong run from commodity prices in the resource sector. And some of the news from China is that despite a slowing economy, they're still purchasing at the same rate in terms of iron ore, if not actually at an increased rate. And so the one great for when you're looking at, mining stocks and you are looking at the resource sector in Australia, which does underpin a lot of the Australian economy. But also when you're talking about property prices, when you're looking at, property prices in those territories where there is mining, that really does have a pretty strong impact on prices in that market as well.
Yeah, well, our commodities businesses that are listed on our stock exchange have had a pretty nice boost recently, with the news of, a lot more expansion in China in terms of building, which needs iron ore because it needs steel. So yeah, hopefully that continues to drive markets as well too. But yeah, if you're up north, that's probably having a positive impact on property prices as well.
Yeah, absolutely. Bills, I think that covers it for a market wrap for the last month. Definitely some interesting things and a lot that's going on in the world.
There's always something going on in the world, and I'm just thinking we didn't get a chance to beat up on the government. Maybe we'll save that for
the next episode, actually,
for the next one. But Andrew, thank you for today. To our listeners and our viewers, hope you got a whole heap of value out of that. Like always, if there's anything that you want to discuss, details are in the show notes. Feel free to reach out to Andrew and I, and we look forward to catching you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of Acumen Financial Planning Proprietary Limited.